Hello friends, this is Denario Research and welcome to the 8th part of cryptocurrency trading tutorial. In this video I'll talk about risk management techniques every successful trader must know. Risk management is an essential but often overlooked prerequisite to successful active trading. After all, a trader who has generated substantial profits over his or her lifetime can lose it all in just one or two bad trades if proper risk management isn't employed. Today I'll show you some basic strategies that helped me and will help you to secure your profits. Planning and analysis. Successful traders commonly quote the phrase, "Plan the trade and trade the plan." Just like in many aspects of life, planning ahead can be often the difference between success and a failure. The next two rules is everything you need to know about technical and fundamental analysis. Market is a chaos, and you always deal with probabilities. Even if you made a perfect analysis, there is always some level of probability that market will do the opposite. That doesn't mean that your analysis was wrong. This means only that it was correct at some level of probability. Therefore, any analysis is wrong until market proves the opposite. And when you enter into trade, as a consequence from rule number 2, any trade is a losing trade until market proves the opposite. That is why risk management is so crucial. You need always assess risk and plan profit, and enter into trade only when risk to reward ratio is acceptable. Let's look how to plan the trade in TradingView. I use Terra Luminis against US dollar T-Zero 30 minutes chart. Let's assume that we are in this point. As you see, downtrend is about to over, and we observe bullish reversal pattern in the bottom of the downtrend, which is confirmed by high buying volume, and a gap between pattern close price and next candlestick open price. As a conservative trader, I will open my long position somewhere here. So let's use TradingView tools to plan our long trade. I put stop loss price below the trend reversal point, so it might be somewhere here, below the low, and take profit somewhere close to previous high. Let it be somewhere here. Always plan stop loss and take profit points ahead when trading. Successful traders know what price they are willing to pay and at what price they are willing to sell, and they measure the resulting returns against the probability of price hitting their results. If return is high enough, then they execute the trade. Conversely, unsuccessful traders often enter a trade without having any idea of points at which they will sell at profit or at loss. Like gamblers on lucky or unlucky streak, emotions begin to take over and dictate their trades. A stop loss point is a price at which trader will close position and take loss on the trade. Often this happens when the trade doesn't plan out the way the trader hoped. Like there is no reversal, it was just correction of the downtrend and it may continue. In this case, we may lose only 10% of equity we invest on this trade. On the other side of the table, take profit point is a price at which trader will close position and take profit on the trade. Often this occurs at resistance level or at previous high, like in our case, and we may earn 32% of the equity we invest in this trade. So our total risk to reward ratio is 3.11. Risk profit ratio is the ratio between amount you plan to earn and amount you can lose. Personally, I prefer trading opportunities with ratio equal or more than 3. That means if I enter into trade, I can lose $1 or earn more than $3. Stop losses are typically placed below support or above resistance levels. When setting these points, here are some key considerations. Don't place stop loss very close to the support or resistance levels, as it's too likely to get executed without any reason. Next, adjust the stop loss according to the market's volatility. If coin price isn't moving too much, then the stop loss points can be tightened. And the last but not least, use non-fundamental events and news as the key time periods to be in or out of the trade, as volatility or uncertainty can rise. The next important factor separating seasoned traders from successful traders is money management. Like dieting and working out, money management is something that most people do not follow. It forces traders to constantly monitor their positions and to take necessary losses. And very few people like to do that. However, this chart proves that loss taking is a crucial thing to long trading success. Just look at numbers. If trader loses 20% just in one trade, he must earn 25% to return his losses. At 50% loss, bank must be doubled just to recover. Also, most traders are familiar with these figures. They are inevitably ignored. That is why most of the traders lose everything in first year. But they can avoid this by controlling their risk through stop losses. Never risk more than 2% of total equity on any trade. By risking only 2%, you are indifferent to any individual trade. And this is a very good approach. A trader can be wrong 10 times in a row and still have 80% of his equity left. But it's hard to develop that habit, and unfortunately you will learn money management only through big losses. Therefore, I recommend you to split your deposit by half and hide one part and use another in trading. There is a high probability that you will lose all a big stake of your trading equity. And of course, never invest more money than you can afford to lose. Also, you need to track your trading history. Create a spreadsheet, it looks like this, where you will put information about your trading, like where you trade, open price, amount you buy or sell, short or long position, your take profit, your stop loss price, and price where you close the position. And the most important part is the comment section, where you will put information about why you open position and why you close position. Track successful and unsuccessful trades and set limit of unsuccessful trades per day, week, or month. And if you reach that limit, stop trading till the end of this period. Look through your comments next to each losing trade and try to figure out the reason of your losses. Risk management is an empirical and individual process. It depends on your personality, equity size, where you trade, market conditions, and so on. I have explained very basic but important risk management principles. There are many practices and recommendations, but there is no silver bullet. You must constantly evaluate your risk management practices and improve them. In the next video, I'll show you simple range trading strategy that uses both understanding of support and resistance levels explained in my previous video tutorial and risk management. This was all for today. Thanks for watching. Thumbs up if you like this video, subscribe to my channel if you want more videos, and leave your questions in the comments section below. Bye.